Well, welcome back again. It's Greg Bell from the Ray White Surface Paradise Group. I'm here to continue our in-depth discussion about the finance market with Rodney Weir here from Green Finance and Loan Market. So, welcome back, Rod. We had in February of this year a Royal Commission into the banking industry. And what was the repercussions from a property agent's perspective? We just saw an enormous slowdown in the ability of people to borrow. And there was a lot of confusion amongst investors as what's this all about? From your perspective as a experienced 30-year veteran in the industry of finance, how do you read that, the ramifications of that Royal Commission?
The ramifications probably aren't even fully known yet. And I think the key is what you said there is confusion. And the main reason there was so much confusion is because the Royal Commission put out a finding of recommendations. That is all they were. They were recommendations. They did not come out and say, National Bank must do this, Commonwealth Bank must do this. Everything in the report was merely a recommendation. The lenders then read the report and put their own interpretation on it, on what they feel is going to come in the future. Because those recommendations, that Royal Commission report, or the Hayne report as they refer to it, it has to go through the Senate for any of those recommendations to be passed. The banks at this point in time, they're guessing just like you and me of what the future holds. So they have to try and implement their policies and procedures and the assessment of loan applications really based on an unknown quantity of what the future is going to be.
Okay. So what's that all to the average layman mean?
It just basically means it's harder to get funds at the moment. The banks are scrutinising a lot more. They're looking at things that they never used to look at. In regard to, most banks now will want to see a minimum of 3 months worth of statements.
Yep.
And they are actually going through and looking at how you spend your money. Now, a lot of people say that doesn't affect businesses or companies or going to buy a commercial property as an investment or to run their business from. However, banks are looking at it as you are the director of that company, so they want to look at your living expenses. They want to look at where you're spending your money to make a determination, can the company or the trust afford to buy that property without you needing to pull money out of that company to pay for your lifestyle? So they're looking at people's lifestyle habits and making decisions on finance based on that. Whether it be, they might look at your bank account and say, oh, geez, you go to the casino a lot, don't you, Greg? They might say, you know what? We don't believe you can actually buy this new property because you're living beyond your means.
Right.
So whereas that was never an issue in the past. Because banks didn't know, they weren't looking at your statements.
So do you see this all freeing up as we march towards the end of this year? And what's 2020 going to look like? I know you haven't got a crystal ball.
It'd be good, wouldn't it?
But you've got a very hands-on feel for the market. So do you see it easing up? Because for us in the property industry, the loosening of finance, the ability for people to borrow as opposed to 6 months ago is really going to drive our market and the property market. And until such time as this confidence come back, what I can borrow and so on and cut through this confusion.
Yeah.
I just see it's a long haul. How do you see it?
Yeah, I think there's two different sections there that you looked at. One about the market increasing. What is going to drive the commercial market is cash buyers. People with cash, or as we just spoke about, people with money in their super. Because they are the ones that are going to pay over and above the market, which is going to push the prices up, because they're determined to get something which is even going to give them a 4.5% return.
Yeah.
Because it's so much better than 1.5%. The freeing up of money for the people needing to borrow to buy, then yes, it will free up. It has to free up. Because banks are in the business to make money. And the only way they make money is by lending money. So the policies and procedures have to change. And that started on Friday with APRA getting rid of the serviceability rate. So we're going to start seeing changes come through, and that should come through in as little as the next 2 weeks, once the banks work out what level they want to put that, or what ceiling they want to put on there. So the hard part there is the two sides. You've got cash buyers who are going to push the property prices up,
Yep.
which will drop your yield. But then you've got the people over here that want to borrow. They can say, well, hang on, I can't afford to pay that. Because if I'm going to be paying a 4.5% interest rate, I don't want only a 4.5% yield. I want to get a 5.5% yield, which they're not going to do. So there's two different sides, which is going to make the future very interesting.
Yeah, I see. So in green finance, working with the loan market and your enormous experience, where's the most active part of the commercial market? Is it people wanting to buy industrial sheds and investments, or is it owner-occupier? What about the leasing of equipment for fit-outs? You do deal in a wide commercial arena and specialise in it. Where's the big demand at the moment?
It's wide and varied. It comes back to the individuals. I mean, there is a lot of owner-occupiers or people that are currently leasing with the yields getting driven up, saying, well, you know what, it's not worth me leasing anymore. I'm going to buy my own property. Now, whether they set up a trust or to buy it in, or whether they buy it in their super fund, they're buying their own to move into rather than leasing a property. So that's something that's very big. In regard to, are they looking to commercial property? Are they looking to industrial sheds? It all comes back to the lease. From an investor's perspective, they're looking at strength of return. And the strength of return can be a good, strong, solid 5-year lease with a 5-year option, as compared to something that's on a month by month. And the tenancy. If you've got a national tenant, whether it be, if it's a service station, someone like a Shell's Express, as compared to Joe Blogg's Fuel, then the strength of the tenancy is something that investors are going for. And it's also something that lenders look at. When an investor is buying a property, the bank looks at your lease, and they look at your sponsor or your tenant that's going to be paying the lease. And you get a good lease and a strong lease, banks will push their lending parameters to do that. And they may lend 70% of the property, whereas if you've got a weaker lease, they might say, we're only going to go 50%, meaning you need a bigger deposit.